Thanks so much for tuning into Talking Point. I'm your host Neeraj Shah, and we've had a full earnings season behind us, and it's been interesting to see how different pulls and pressures have worked around separate themes. Healthcare was obviously one of the key themes that was monitored this quarter, as also every quarter now, simply because the theme has expanded to so many verticals in the last 12 to 24 months that it becomes imperative to try and understand what goes behind each of those, what are the valuations current looking like, and how's the outlook for that space going ahead. And to do that, we have with us today Nitin Agarwal from DAM Capital. He, amongst other things, he tracks healthcare very, very closely. So we thought it's best to talk to him about that space. Nitin, good having you. Thanks for joining in.
Thanks, Neeraj. Good morning, and thanks for having me.
No, the pleasure is ours. So Nitin, sum it up for us first before we get down to the nuts and bolts. One, what do you think? What did you think? What do you make of the numbers per se for the quarter gone by? And based on the kind of uptick that is coming to almost all themes and not just healthcare, what gives you comfort on the valuation front and what doesn't?
Sure. So let me just break it up into two parts, pharmaceuticals and healthcare services. Let me take off with pharmaceuticals first. Now, on pharmaceuticals, when we entered the earnings season, we entered with not too much optimism, right? The pressures which were there on the businesses, especially in the export side, were known, and there was very little signs of the easing off, right? So the export was in any case a subdued story for the quarter when we entered the quarter. Domestic, we had a very, very strong Q1 of last year because of very high based on account of COVID driven treatments which were there. So I mean, there was essentially a sense this quarter is not going to be great for the sector. Not much was expected from the sector, from the pharmaceutical sector when we entered the earnings season. And as things have played out, I mean, the three or four things stand out really. I mean, exports have not done much, right? There has been essentially exports. US is a primary market. In the US, in most cases, we've seen sequential decline in revenues, or we've seen marginal uptick in revenues in most cases. Okay. And the ROW exports also have been kind of muted, right? So exports has been a softish sort of story for the quarter. Domestic, based upon how companies were in their base of last year, right? If they had a very high COVID base, they were struggled to grow on that. And if they didn't have too much of COVID sales last year, they've done well. So domestic essentially has been a very broad-based, dispersed, earning quarter from a domestic growth perspective. Exports has been soft. So that was, I think, revenue growth was more or less at some level in expected lines. Some cases where US growth was high, decline was higher than expected, but that was odd. But the big sort of standout feature in this quarter was essentially the pressure on gross margins, and that is something that we see pretty much across the board, right? And it sort of took us by surprise because till about the last quarter, at least the formulation guys were not showing this pressure. But it was. I mean, there were various kind of pressures which were there around solvents and crude linked derivatives and stuff, but it never really showed up. But I think this quarter, the gross margin pressure came back with a very strong, with a bang, literally. And we saw compression happening in gross margins across the board, and we probably see gross margins that companies had not recorded for a very long time, right? And that, and given the fact that there's limited leeway room companies had on cutting out on reducing overheads or optimizing overheads, it led to pressure on the EBITDA margins, right? So the story for the quarter clearly has been about muted exports growth, okayish India, but very sharp pressure on gross margins. And when we sort of looking out, I mean, there's very clearly there very little to suggest that the gross margins will worsen from here, but where they're limited. In the immediate term, there are no major meaningful triggers also, right? So it's going to be a gradual uptick as we go through the year, unless not until commodity prices come off very sharply. Otherwise, even if they begin to come off, typically companies carry inventory, and so the impact plays out only with a lag. So I guess Q2 maybe slightly better than Q1, but eventually as we go forward with it, things will improve. I mean, we have probably hit the bottom, around the bottom, but the pace of improvement in gross margins is going to be something that we need to watch. So that's on the gross margin. The other bit that's going to change on the sector essentially is, domestic has, after the COVID phase is done, I think Q1 was a high COVID base. Domestic be back to normal growth now, right? Market should grow about 8-10%, and companies, depending upon how well they are growing, will grow faster than the market or in line with the market. Domestic is normal. The uncertainty, as always, is on the export side, right? Now on the exports, Q2 again, not much to really expect in most cases. But I think our belief is come second half of the year in the US, especially for the large companies, our outlook will start to look a lot better because across the board in most of the companies there are, especially the larger companies, there are a lot of triggers. There are triggers which are there for potential big ticket launches in the US. So that will help to take up the US growth and typically what happens in exports is a literally like a commodity business in some sense, right? In the sense you've got costs which are fixed. So any operating revenue leverage which comes in flows down directly to EBITDA and PBT. So the moment exports growth begins to pick up, you start seeing significantly improved profitability from the export part of the business.
Sure.
So our sense is as we go in the second half of the year, exports will start to look a lot better for at least for the larger companies. And in general, the earnings picture gradually for the sector should look up as we go through the quarters.
Got it. Okay, I'll talk about the health services or healthcare in a bit. Since we've started with pharma, let me try and probe that a little bit more. So here's my question. A conversation with a few global pharma experts, Nitin, seem to suggest that Indian exporters, while they have these near-term triggers of launches otherwise, need to find some novelty factor and some niches, because US is increasingly becoming a buyer's market, and with inflation numbers looking the way they are, even if they come off a little bit, the buyers will keep on putting pricing pressure, and therefore sustained earnings growth or a sustained or a cyclical rebound of a meaningful manner might not happen. Where are you on this argument?
I am with you on that. I guess there has been one major structural change in the US market. There have been the two changes which have happened in the US market over the last maybe 3 years, right? See, US always was a market where, where you always had price erosion, right? But I guess what has happened is two things. One, as I said, one is as you mentioned, the buyers have got consolidated. Now, three buyers pretty much control pretty much the entire buying space over there, right? So the terms of trade are in favor of the buyers. I mean, clearly as things are. Secondly, what has happened is in US, as I said, erosion is always part of the game. Companies, if they were selling maybe 100 products, they were not making money on all the 100 products, right? They were always making money on the 20%, 10 to 15, 20% of the products. And when you were making those monies on the 15, 20% of the products, there were two characteristics. One is either you had some sort of a quasi-exclusivity or a limited competition situation, or two, there were shortages, and you were participating in the shortages and making money out there. Now, two things have happened. One is such opportunities of semi-exclusive opportunities have become very rare. Now it's very difficult to find a 30, 40, $50 million product. Not to say they don't come, but they come with a very less frequency, right? And two, I mean, FDA seems to have done a phenomenal job on managing shortages. So what our conversations with companies suggesting it over the last 6 to 9 months, there have been very, very few shortage opportunities. So the issue which is happening in the USA is while the base business pressure continues, there is nothing to make up for it, right? Either by way of exclusive launches or by way of shortages. Till the time either of those things kick in, right? That's the only thing which can save a US business, right? Without these two opportunities, you'll never make money on 100% of your portfolio.
Got it. Okay. Just one quick follow-up, Nitin. The bull argument out there, in some fashion, at least until 18 months ago, that somebody had suggested was that because this business is very cyclical and almost a commoditized business, this US business, that if pricing stays lower for longer, it'll drive away some of the weaker balance sheets, some of the higher cost manufacturing options, and therefore the Indian exporters will stand a chance of a meaningful comeback. You think that argument now doesn't stand true?
No, in fact, it still holds. The reality is that most of the companies, even the US, typically they have a large manufacturing or sourcing base from India. I mean, most of the pressure in the US is on account of, in most cases, because a large number of Indian companies who are participating, right? Okay. So the issue is not so much about India versus US. It's about the ferocity of competition from Indian companies itself, right? Which is creating the pressure.
Okay.
And you're right. At some stage, if there is not much money to be made in the US, I mean, companies at some stage will have to start evaluating, and people will take their own time to evaluate. When do they begin to cut their losses, and then companies are willing to sort of last through the cycle, and they have a clear intent to stay in the US. US as a primary business over a period of time will eventually gain, because I mean, the good thing about pharma is, while there's a lot of, see, the thing is, the underlying demand dynamics for the business have not changed at all, right? If anything, globally populations are aging, right? The consumption of medicines is just going up. That is not going to change at all. Nothing changes that. The only dynamic which has been at play over here is the pricing, right? And pricing takes its own time. Yes, what has happened is the rebound in pricing has got delayed by much more than we expected. There was a view that 23 onwards, FY23 onwards, we'll probably see a rebound in pricing. That doesn't seem like it's going to happen, especially in the oral solids. It'll take some more time. There's probably some more companies are still holding out. But from this quarter, I think we're beginning to see signs of that. Various companies in the con calls have indicated that they're reviewing their portfolio and they begin to start withdraw from certain products. Right? And my sense is if this pain continues, we'll probably keep hearing more and more of this news flow as we go along. And I guess at the end of it, we'll probably have a few guys who are willing to, whose business model in the US is based around cost competitiveness. They sort of get to benefit when the storm ends.
Got it. So Nitin, therefore, I'm just asking you for what has been published, all right? And therefore, I want to understand, based on the current valuations, the opportunities that exist, the new launches, as the case may be, purely for the companies which have got this US side of the business, what is the pecking order and why so?
So, what we like essentially, as I said, companies where the earnings exports will pick up are the ones which are probably the preferred businesses for us. Our pecking order right now, the large caps is Cipla, Sun in that order, right? Cipla probably, as we published, essentially has multiple big ticket launches potentially lined up in the second half of the year. They've got the best launch portfolio amongst the larger peer set, right? So that really stands out from potential from way of earning pickup in the second half of the year, plus upsides, because some of these big ticket launches can always surprise you in the positive if things fall in place. And Sun, because it's a differentiated business with limited reliance on generics and very, very strong bulk of the growth being driven by specialty, it is not really impacted much by some of these generic challenges.
Got it. Okay, great. Nitin, just a quick word on the on the companies focused on the domestic business alone. And there, I mean, I saw fairly mixed performance in the quarter. And please correct me if I'm wrong, but I thought it was patchy at best, in some cases well, in some cases not so much. What did you make of the performance for companies which are focused purely on the domestic side?
So that is honestly to be expected at some level, because as I said, there was a large COVID base last year. And depending on the portfolio, you had a very large high growth last year. For example, if you were selling anti-infectives, you were selling out on the COVID drugs, you had a phenomenal Q1 FY22. So it is a normalization of the base. Yes, some companies have done better, but I think a lot of the dispersion is explained by the base of last year.
Okay, fair call. And I mean, just there are a lot of questions that come in typically, right? About there are some companies which have marched on really well over the last 5 years, and I'm not taking a 1 year view out here, but a 5-year view on their sales CAGR, on the price performance versus some others purely domestic focused businesses. So is there does the house per se have a preference for anything? And are there reasons for that preference to exist?
So, I mean, my belief essentially is that, there are obviously, the good companies in each space, right? Good executors in domestic business as well as in generic business. The reality is generic business is right now going through its trough, right? Mm-hmm. So the outlook for that space is not so great at this point of time.
Got it.
So
okay.
For the time being, the domestic obviously domestic is a better place to be in. And obviously, companies who are executing better in the domestic market are relatively better off. That being said, I personally, for one, believe that the reason why, frankly, most of the Indian companies have gone into exports is because domestic is a defined market. I mean, it's a market is going to grow at 10%. You can grow a little higher than the market, but that's what you are, right? The market opportunity for pharma is outside of India, right? The big opportunity, right? I mean, there is higher profitability, higher ROC in domestic market, but the scale-up opportunities are outside of India. Right. Okay. So, I mean, one can take so I guess to the extent, to my mind, a generic is not a bad word. Yes, it's a side business which is going through its own cyclicity. And companies who come out strong, sort of who survive at the end of it will really make good money for themselves.
A word on the API companies, because they seem to have also given mixed results, but are they on a better footing per se? What's your sense here?
So API, the broad story stays, right? In a sense, again, the proxy which I take here is, I mean, if India essentially is the pharmaceutical factory of the world, what Indian companies do is indicator of how the global landscape is sort of playing out. Now in API particularly, third-party APIs, for example, we've seen hardly much third-party API capex investments happening over the last several years, right? If Indian companies are not looking to invest in APIs per se over a period of time, and inherently, as I said, the volumes of the business are not coming off. So there's a structural story which is there on APIs over a period of time because people are not putting money in API capacities and volumes for drugs are still going up. Right? But that being said, so that's a broad story, right? And China plus one and all that can play out as further tailwinds. So that's a long story, but the short-term story here is like this. See, FY21 was a very disruptive year for pharmaceuticals per se, global pharmaceuticals per se, because COVID and the supply chain disturbances coming out of China created a lot of confusion in the supply chain. So there was a lot of overstocking which happened for drugs. In a lot of cases, certain drugs sold a lot more. The velocity of those drugs, volume sales of the drugs went up meaningfully, right? So FY21 was an unusually good year for a lot of companies, including the API companies. And that, because no one knew what was coming subsequently, has created a lot of confusion on the supply chain. So there's been overstocking of inventory, there has been overproduction in certain products, and all of the normalization is still happening as the whole of FY22 was normalization of the excesses which happened in FY21. And what has not helped in FY23, as we speak right now, is a lot of the costs which have gone up around oil and solvents and all of that. API guys are the first port of call to handle that cost. And typically API guys don't pass on those costs very easily to their front-end customers till the time they believe that the cost pressures are stable, are here to stay. So for now, the API guys are struggling with still in a lot of cases on molecule-specific overstocking or still lower demand on a molecule-wise on molecule-specific cases, and also higher cost pressures. Incrementally, things will look better, but I guess again in this case also, as you said, that 23 is going to be the rebound year. That's got pushed out by a few quarters.
Got it. Healthcare services, Nitin, and what's your sense here? Because the jury is split right down the middle when it comes to how the performance of the diagnostics or the hospital chains could be over the course of the next 2, 3, 5 years because of the competitive scenario. And the companies are somehow very confident of how their branding and their quality will stand out, and the newer entrants will not have it easy, either on the pricing side or on the business traction side. What's your sense?
So on healthcare services, our clear preferences towards hospitals over diagnostic services.
Okay.
Our view is that for the fact that both of these businesses pretty much offer you almost the same earning visibility, right? And give or take a 15% earning EBITDA CAGR, right? That's pretty much an optimistic case for B2C diagnostic businesses, as well as most hospitals should be able to deliver that kind of earnings growth. I mean, the multiples premium which is there for, and hospitals have a far higher entry barriers than B2C diagnostic businesses do, right? So our preference is clearly towards hospitals over diagnostic services. I mean, a lot can go wrong for diagnostic services at this point of time, right? In a sense, we don't know how some of the competitive situations can actually play out. Yeah, I mean, there is a case. It may not be as worse as we expect, but a lot can go wrong from where we are today. Right? Not a lot can go wrong for hospitals, because what we've seen essentially is the bulk of the organized healthcare hospital space in the country is in tier 1 metros. Right? That's where bulk of the network today is. We've hardly had new hospitals coming up in these regions over the last 5 years, and similar is going to be the case over the next 5 to 10 years. In an economy where economies are growing on a consistent basis, disposable incomes are increasing on a consistent basis, people are getting older as we go along, right? And you've got only limited set of healthcare facilities. I mean, the demand supply is skewed towards towards the healthcare service providers, right? You cannot recreate new hospitals. It's not easy to do that in large towns and metros, right? So the entry barriers in hospitals are very large. Yeah, the question is, at what stage, at what pace can they grow their revenues? What pace can they get price hikes on an annualized basis? But I guess with the inflation that we are seeing, all services are gaining from the inflation which is around us, right? So our belief, are we more positive on hospitals in general? We believe diagnostics, the path ahead is fairly uncertain. and the multiples don't leave you any room for any margin of safety on that account.
I was about to ask you that you don't reckon that the price corrective move that we've seen bakes in some of these pressures. You still think that even if they're not very expensive, they're certainly not cheap, the diagnostics?
Oh, they're expensive in my view.
They are expensive, okay.
For the earning that visibility that they offer.
Okay. And you reckon there is value in the hospital services business currently?
So I mean, so even in hospitals, for example, hospitals they've had their share of re-rating, right? Multiples have gone beyond where they were probably 2 or 3 years back. But I guess, but the performance of hospitals also has improved meaningfully versus what we expected them 2 years back. I guess across the board, if you look at hospitals, there's been earning upgrades which has come through for 24, for example, 23-24. There've been a series of earning upgrades which have come through across the board. So the performance of hospitals has been a lot better than what we expected. That's the reason which is driving the multiple upgrades. And my belief is, some of these earnings, we don't see a downturn in earnings happening just yet.
Okay. So Nitin, as I understand, diagnostics, you believe they are expensive. Hospitals, there has been a re-rating that has already happened. On the domestic side and the APIs, you mentioned that some of the traction will take time to come. The place where probably there is some tactical traction possible is the US-based exporters, wherein a slew of launches might be helping them in their earnings trajectory. So in some sense, that's probably that one bucket within this service, within this pharma and healthcare services space that might have some near-term possibility of traction, according to you. Purely price movement, not really investment grade conversation right now.
So I put hospitals and then the US export, because the hospital, see, the export bit is more like a second half story, right?
Okay.
By the time hospitals, I think the near-term earning momentum is the strongest in the hospitals, right? Because most of them have a lower COVID impacted base of last year to contend with. So YOY earnings is a lot better. And QOQ, month on month, the conversation that we've had with companies post the conference call, post the earnings call was, I mean, things have just improved month on month as Q1 ended. And the momentum can very well carry over into Q2.
Wow. Okay. And you reckon this could happen across the board, because there are some cancer specialists, some general hospitals as well, and some large, some small. But you reckon across the board there could be traction on earnings?
Oh yeah. I mean, extent could vary, but I guess clearly I'll be surprised if you don't see a better Q2 than Q1 in most cases.
And arguably a strong second half as well.
Yeah, I mean, so not as much as, see, momentum is right now continuing. Now the issue is how much can you further grow QOQ on this base is an issue. But because Q3 was very strong for hospitals last year. This was the first quarter in Q3 last year when the COVID impact was not there. A lot of pent-up surgeries and all really came through in that quarter. But in general, I think, it's still a very positive set of numbers to look forward to in the hospital business.
Great. Well, Nitin, thank you so much for your time. It was an elaborate conversation, but it helped us understand what's happened in the quarter and the outlook ahead as well. So much appreciate this and look forward to talk to you again.
Thanks, Neeraj. Thanks for having me. Bye-bye.
The pleasure was ours. Viewers, thanks for tuning in.